All right, warm welcome everybody to a brand new week, and let me also say brand new month. I mean, we are entering the month of September. It's just crazy how fast time flies. Feels like we should be somewhere around March, maybe April, but not September. But anyway, it is what it is. Time flies like crazy these days. In terms of looking at the calendar for the week ahead, the first week of September, look, it's a packed one in terms of economic data, no doubt, but let's not kid ourselves. It's all going to be about that US jobs data on Friday. There is plenty else going on. We have the likes of the ISM surveys as usual. We've got some Eurozone inflation data out early in the week. We have some Australian GDP data. We have some UK retail sales, Canadian jobs data as well. But NFP on Friday will definitely be the main event. And it has the potential to, in my opinion at least, keep the majority of market participants basically just, sitting on their hands for the majority of the week, keeping their powder dry until we see what happens with that NFP. I mean, for this particular NFP print, guys, it's really going to be, an interesting as well as I think a difficult one for the Fed. If you take a look at the recent data, let's start with CPI. CPI has put the Fed in a bit of a tough spot right now because inflation is still too high for comfort. We had that big pop to the upside in the PPI data recently. We had upside momentum in the core PCE, upside momentum in the core CPI data as well. I mean, super core PCE has risen 3 months in a row now. That's definitely not something that the Fed will really feel too comfortable about. If you take a look at growth, where the growth is sitting, we know that last week we saw the Q2 GDP data being revised higher to 3.3% GDP. That's excellent. And if you take a look at the current Atlanta Fed GDP nowcast, that is tracking at 3.5% for the Q3 number. So growth is looking really, really solid. That's also backed up if you take a look at things like the Citi Economic Surprise Index for the US. You can see that economic data has, in the aggregate, come in much better than what the markets had anticipated. So you've got solid growth, you've got high inflation, you've got overall economic momentum that remains positive. But here's the kicker. Last month's jobs report, that was soft enough to force the Fed's hand into looking to cutting rates as early as September, right? Fed Chair Powell admitted at Jackson Hole that rate cuts are more likely after that jobs data that we got. And that kind of just confirmed what other FOMC members like Waller and Bowman said openly, basically saying that they favor cuts for September as well as December. Now, that does mean that the bar to not cut rates in September is very, very high, right? They've already come out, they've already told us that there's a high likelihood they are going to be cutting rates. That means that the bar for September is fairly high for them not to cut rates, but it's up for grabs about what happens after September. And that is really what, the incoming labor market will steer the markets towards. To a lesser extent, the CPI data as well. We do get another batch of CPI data coming up, to be fair, before that September meeting. But the main focus will be on NFP, not just for the September meeting, but more so what happens to the Fed or interest rates after that September decision. When it comes to the labor market, I mean, looking at NFP, the signals right now, it remains very, very mixed, guys. If you take a look at this data, let's quickly go back to that NFP data that we had. If we look at the NFP data, let's actually look at that first. Let's look at that revisions data that we had. Here we go. What we have on this bar chart is we have the initial numbers for NFP, which is the blue bar, and we can see that prior print that we had back in July was pretty bad at 73,000, right? And then, of course, we had those huge downside revisions as well, which was the main reason for the markets taking that recent dovish shift, right? It wasn't just down to the low 73k. It was the fact that it was revised lower from 147 for June down to 14, and from 139 all the way down to 19. The markets did not like that at all. However, even though we had that big discrepancy, that big push to the downside in the revisions, it's not all bad, right? This print is what kickstarted all of the dovish concerns we have right now, or at least that the Fed and other market participants have right now. But under the hood, we're not really seeing this playing out in all of the economic data that feeds into the labor market, right? If you take a look at just the unemployment rate, for example, the unemployment rate has gone absolutely nowhere since last year, July. We've moved down a little bit sometimes, back down to 4.1 and 4%, but we've basically just been stuck around that 4.2% level, and that is despite that continued downward momentum that we've clearly seen in the labor market. So yes, actual jobs created has definitely been trending lower, but that has not yet hit something like the unemployment rate. It stayed flat. In other words, fewer jobs are being created, yes, but it's not yet showing up in people actually losing their jobs, right? Immigration dynamics, I think, is definitely playing a part of this. We've had a couple of participants coming out recently talking about these things. But in a nutshell, fewer new jobs are needed to basically keep the unemployment rate steady. So yes, let's say a jobs market continues to soften and we continue to see lesser jobs created. As long as the unemployment rate stays flat at 4.2%, there's not supposed to be a lot of concerns there for the Fed. Furthermore, we've looked at this last week as well, and the week before that. If you take a look at something like initial jobless claims, which is normally a very good trigger of stress in the labor market, we are nowhere near stress levels. Nowhere near stress levels when it comes to initial jobless claims. If you look at the 1 year percentage change of that, we spoke about this as well last week, saying that every time that we've gone to about 20 to 30% up on a year-over-year basis for initial jobless claims, the US economy was already in a recession when that happened. Currently, we are tracking at -3, so nowhere near stress levels when it comes to the labor market. The labor market right now just doesn't scream recession. So is the labor market actually breaking, or is it just cooling at the margins? My personal opinion is that we're just cooling at the margins. We're not seeing something scary, but that is the question that markets and the Fed wants answers for with this week's data. That's why the NFP will be so important. In terms of expectations for the event itself, we can see markets are currently expecting another print below 100K at around that 75K mark. Unemployment is seen ticking up slightly from 4.2 to 4.3, and we're also expecting a drop in that year-over-year earnings number down to 3.7. Now, in terms of what this print might mean for major assets, let's start with FX. Let's focus on the dollar first. Look, when it comes to the US dollar, it hasn't had the best of weeks. Let's say 2 weeks now, because we obviously had that big drop to the downside with Fed Powell's speech at Jackson Hole. And then obviously the dollar drifted lower from about the middle of last week as well, in line with the expectations that we had going into last week. Now, for the dollar, when it comes to NFP, positioning and market pricing is already short the US dollar going into this NFP, right? We have institutional investors at the moment very, very long, something like the euro versus the US dollar. If you take a look at euro positioning, basically still at the highs, and this is against the US dollar. So the markets are already short the dollar. They were short the dollar going into Jackson Hole as well. So when you've got the markets already short the US dollar, and you have rates markets already fully pricing in 2 cuts by the end of the year for the Fed, what that means is that if we just get a very small miss in NFP, right, something, let's say like 65 or 50,000, if we just get a small miss, and the unemployment rate stays, ticks up from 4.2 to 4.3, but it stays in line with expectations, that is not the type of thing for me personally, that I would find attractive to try and push dollar shorts on, right? For dollar shorts to really have fuel, and I mean to have enough fuel to potentially break through that very key level of support around 97.70 and potentially retest the low going back to July, which was around 97.10, and then potentially back down towards the early July low at 96.30. For us to see these levels, it would probably take a negative NFP number, right? A negative number like -10, -20, etc. That would also probably require further downward revisions to those prior data that we had. It would probably mean that we need to see the unemployment rate at least 4.4% or higher. If we were to get that type of number, right? A negative NFP, upward unemployment, further downward revisions, that would, in my opinion, be attractive for dollar shorts, because it will most likely see the markets not just fully pricing in 2 cuts like they already are, But that'll most likely see the market starting to price in a high probability of seeing 3 cuts for the rest of the year. 1 September, 1 October, as well as December. Remember, right now markets are already priced for the one in September, already priced for the one in December, but October is basically 50-50. If we get a negative NFP, further downward revisions, upside in the unemployment rate, that could see the markets very easily, in my opinion, pricing 3 cuts this year, and that could be good to look for some additional downside in the US dollar. On the flip side, you know, the more interesting setup for the dollar would be a beat, right? Markets are already, like I said, leaning heavily against the dollar. Cuts is already fully priced in, 2 of them. So a stronger than expected print, plus potential upward revisions where we saw those downward revisions, that would force positioning to unwind in the US dollar. Now, keep in mind, a hot print, this is important, a hot print won't necessarily mean that the markets price out September's cut, because remember, the bar for them not to cut in September, after Powell basically told us there's a high likelihood they would, the bar for that is high. But because a hot number wouldn't change September, doesn't mean it can't change that December expectations. That is what we want to trade if we get an upside surprise. We want to see the markets pricing out the probability of a December cut, and that obviously making some upside potential in the US dollar very attractive. Now, key levels to watch there for both upside and downside. Obviously, we're currently sitting at a huge level of support. This one will be key. If that one falls in the week, potentially with some of the other incoming data, obviously on the back of NFP, if we manage to break and stay below this, that'll be your next key level of support to watch around that 97.10. And below that, you've got the cycle low for the US dollar coming up around that 96.40 level. That's going to be critical. If we manage to break through that level, let's just see where the next key level of support is. Below that, the next key support only comes up around that 95.20 level, which is the lows going back to Feb 2022. So very, very key levels to watch there to the downside for the US dollar. What about if we do get that hot number, we see some positioning unwind? First area to target, we can see a nicely confluence of the weekly implied volatility high, is this whole series of rejections that we have for the US dollar around that 98, 80, 99 psychological level. That'll be the first area to watch for possible resistance, and then above that, that huge level around that 99.50. This has kept the dollar at bay going back all the way to June. So those will be key levels that I'll be watching very closely in the week ahead with that NFP in mind. Apart from that, let's take a look at some other markets like equities. Look, for equities, the sweet spot for this week is probably just a very marginal miss in the data. Something soft enough to keep both those cuts for September and December alive, but not something that's bad enough to like start screaming recession, right? If we have a modest downside surprise, that should keep the Fed easing story intact, and that should be equity positive at the margins. I would argue though that even a slightly hotter print, not something like super hot, but imagine we get like 85 year with some marginal upward revisions to the prior data and the unemployment rate staying flat. If we get like a positive print like that, yes, theoretically it could see a little bit of a move lower in equities, because that could start to push back against the cut expectations for December. But if the labor market turns out to be fine, and we know that growth is really solid, if growth is good and the labor market is fine, that's really good news for the economy and good news for earnings expectations, which means that if we were to get like a small beat, we might see that initial dip in equities, but the market might likely look to buy any of those types of dips, because overall that should be very good for earnings expectations and equities in general. Where things get a little bit tricky for equities is if we see a really ugly print, right? Negative NFP, further downward revisions, a big pop to the upside in the unemployment rate. This is where it gets tricky, because yes, that type of number will probably see the markets pricing in, like I said, 3 cuts instead of 2. Now, theoretically, if we're expecting more cuts, that should be positive for equities, right? Theoretically speaking. But if things get so bad that we do get a negative number and further downward revisions and the unemployment rate spikes, if that starts to bring forward recession fears or massive slowdown fears, investors will probably start worrying that the slowdown is getting out of hand and the Fed is too late to the party. And in that case, the old, bad news is good news logic probably breaks, and bad news will probably just be bad news for equities. So the sweet spot would be either a very small miss or a very small beat. I could see both of those opportunities being good for equities. The worst case scenario would be a super ugly print that sees the markets just taking an overall bad view of the US economy and that potentially seeing equities dumping lower. In terms of key levels to watch for equities, let's start on the softer potential number if we do get some upside. Key level to watch would be prior all-time highs from last week, right? That comes in around that 6,500 psychological level. That's going to be massive resistance for this. If we do manage to pop above this, like I said, on a slightly softer print or just a slightly hotter print, both of those should be positive. If we get that type of outcome, what to aim for next? I mean, how long is a piece of string? If we break above prior all-time highs, there's no way of knowing when this train stops, right? So key levels to watch for, as always, when you move into this no man's land, is those round numbers. So looking at 65.50, looking at 65.75, 6600, 66.25, and we obviously have the weekly implied volatility high coming up around that 66.50. So all of those will be key levels to watch to the upside. To the downside, first key level of support comes in around those lows from a couple of sessions ago, around that 63.46. Below that, we've got the implied volatility weekly low coming up around 62.75, and that is in line with this huge level of support that we have here for the S&P. If we were to get, like I said, a marginally strong number and equities dips lower into any one of these two levels, I would expect that to be attractive opportunities for investors to rotate back into basically buying the dip from those levels. So key level to watch there for equities. What about gold? Now, when it comes to gold is in a very, you would expect it to move the exact same as equities. So in very simplified terms, you would expect a bad print to be good for gold, and you would expect a really good print to be bad for gold. However, gold is slightly different in terms of how it reacts to interest rate expectations, right? So if the base case scenario for gold would be the dollar's worst case scenario, right? So even though we would expect both the dollar and equities to go down on really ugly data, gold is that one asset that you would expect to do well even if the economy really shows signs of breaking down, right? A collapse in payrolls with further big downward revisions, a higher unemployment rate, that would be the ideal environment where gold could be expected to do well. The combo between yields pushing lower on that type of miss and the dollar pushing lower should see gold potentially taking aim at prior all-time highs. I mean, prior all-time highs comes up around that 3,500 level. So a massive ugly number probably puts that in the scope of investors to aim for to the upside. We had a beautiful move and break to the upside on Friday, currently sitting at key resistance. So if we do get a slower print, a very ugly print, that could be on the cards for next week. And obviously vice versa, the worst case scenario for gold would be a very hot labor print. If we get upward revisions to those prior data, steady unemployment, upside in the NFP, that would turn or would in turn see yields pop higher, the dollar pop higher. And if it's a hot enough print to see cuts for December's or odds for December's cut fall, that should be very negative for gold. Key levels there to watch, obviously key support would be that prior highs going back to the 8th around that 3,400 level. Below that, you've got the weekly implied vol low coming up around that 3,380. And below that, you've got 3366 as well. All key levels to watch there to the downside in the event that we do get a hotter print coming out from that NFP. Now, in terms of the rest of the week, like I said, we've got a couple of things coming up. Beyond NFP fireworks, we obviously will be watching the ISM prints as well. We've got the ISM manufacturing coming up on Tuesday. We've got the ISM services coming up on Thursday. This will give us clues about any type of tariff-driven cost pressures when we look at the things like the prices paid component, but I don't think these will matter as much with this NFP coming up, I think the employment indexes of these two will be by far the most important things to watch. If we get massive breakdowns there or massive improvements there, that could potentially trigger some short-term movements in the markets, but we would need to see some really big deviations to get me excited about trading those. We also have some flash CPI data coming up for the Eurozone. I don't expect that to matter. I mean, core is expected to print at 2.2. It's not low enough to justify more ECB cuts, but if it's soft enough, it could keep some of that chatter alive. But we probably need to see something like sub 2. I don't really see that happening. I think that's going to be a nothing burger. We also have some GDP data, like I said, coming up for Australia that is expected at 0.5 quarter over quarter. Look, I don't see that as a big focus for the Aussie unless we see some really big deviations. I mean, if you look at positioning right now for the Aussie dollar, the market is still very short the Aussie. So what that means from a potential tradability point of view is that if we were to see a much hotter than expected number, maybe that could be good for some very short-term reactions to the upside for the Aussie, because that could see some of these short bets being trimmed. But again, not something that I'm too excited about trading. We also have the Canadian jobs data coming up on Friday as well. We had a pretty ugly response, or good response, if you will, to the ugly GDP data that we had from CAD last week. Had some pretty ugly numbers. The CAD, for the first time in quite a while, responded very well to the data, pushing lower. So if we were to see a very ugly print coming out for Canadian jobs, that could be good or interesting, at least for some CAD shorts. Now, the other data point that we do have coming up this week, as always, because it is NFP week, is ADP. Now, I usually ignore ADP. But this time around, it could be interesting for a possible scalp opportunity in the US data. The reason why I say this is it should be no surprise to any of you. If you've listened to me for a while, you know that I hate the ADP as a data point. And the reason for that is just take a look at these huge divergences that we normally have between the ADP and something like NFP, right? On this chart over here, let me just quickly do that. You can just see those weird, massive discrepancies that we normally have, huge deviations with if NFP comes in or ADP comes in super hot, we sometimes see, close to an 80 or 100K difference between that and something like NFP. But there is something that quite a few participants have been latching onto over the past couple of weeks. And that is that if you compare ADP, let's put up ADP. If you compare ADP to the unrevised NFP data, right? There's those big deviations that we normally see. But if you actually look at the revised data, like the ones that takes into account those big downward revisions that we had, if you then compare that to ADP, ADP was actually fairly accurate over the last 3 or 4 months worth of data. Let's call it 6 months worth of data. So this means that ADP could be getting a little bit more attention this week, because some participants are saying that, listen, this thing has actually not been too bad as a predictor. Maybe that could trigger some additional short-term tradable volatility from the ADP as well. Again, I normally hate trading this thing because it is so bad at predicting NFP, but because this is or has been something that's on the radar for a couple of participants, it could be something that triggers a little bit more volatility compared to normal. So that's going to be the main focus point. It's all about the jobs data, key markets, dollar, gold, equities. That'll be the key focus for me for the week ahead. We looked at those key levels. We will obviously have more to say about this the closer we get towards that data, but that is, I think, the main focus for the markets. Again, we could see some vol coming out from the ISM and the ADP and all of those things. They could be tradable short term, but I think majority of participants will be keeping their powder dry, mainly focusing on what that NFP tells us about the likelihood of Fed cuts, not just for September, but more so focused towards the remainder of the year as well. So with that said, I hope everybody will have a fantastic week ahead. And as always, any questions, don't hesitate to let me know.